Something doesn't add up right now. Silver is holding above 75, even after the ceasefire talks just failed overnight. Markets were pricing in peace, but what they just got is uncertainty again. And when markets get it wrong like this, they don't move slowly, they reprice. So the real question is, are you early to this move or about to watch it happen without you? Because after nearly 21 hours of negotiations in Islamabad, the ceasefire talks between the United States and Iran have ended without agreement, leaving major gaps unresolved and tensions still active around the Strait of Hormuz. No deal, no clarity, and more importantly, no stability. Now here's where it gets dangerous. Just a few days ago, markets were telling a completely different story. A temporary 2-week ceasefire triggered one of the biggest sentiment shifts we've seen this year. Oil prices collapsed nearly 13% in a single move, and global markets surged as investors rushed back into risk assets. Silver reacted immediately. Prices jumped around 3.7% as easing geopolitical tension reduced fears of energy-driven inflation and pushed expectations toward a more flexible central bank policy. At that moment, everything looked under control. But that control may have been an illusion. And if you're watching this right now before the next market open, you need to understand what's changing. And real quick, if you want real market breakdowns like this with no fluff, make sure you hit like and subscribe, because what's coming next, most channels won't explain this clearly. Because even during that relief rally, something didn't add up. Silver didn't drop after the ceasefire. It held strong. In fact, it kept gaining, rising another 1.6% as investors started questioning whether the ceasefire would actually hold, especially with ongoing tensions and disruptions around the Strait of Hormuz. Pause for a second, because this is where most people lose the plot. Markets don't move based on what's happening. They move based on what they think will happen next. And even while headlines were talking about peace, the market was quietly preparing for instability. That's not a reaction. That's positioning. Now step back and look at the bigger picture. This is no longer just about war. This is about inflation, liquidity, and central bank pressure all colliding at the same time. Because energy markets sit at the center of this entire situation. Around 20% of global oil flows through the Strait of Hormuz, and any disruption there directly impacts global inflation. And inflation right now is already fragile. Recent data shows that U.S. inflation remains sticky, while economic growth is slowing, creating a situation where central banks like the Federal Reserve may have limited flexibility. That creates a dangerous setup, because when inflation stays high but growth slows, central banks get trapped. They can't cut aggressively, they can't tighten too much, and that's where volatility begins to expand. And here's where silver becomes important, because silver is not just a safe haven, and it reacts to liquidity, interest rates, currency strength, and industrial demand. Right now, silver is trading around the mid-$70 range after a strong rally driven by a weaker dollar and shifting expectations around interest rates. But what's critical is this. Even during a so-called peace phase, silver refused to break down. That's not normal behavior. That suggests the market never fully believed the narrative. And if you're still watching, comment below silver. I want to see who's actually paying attention to this shift before it happens. Now let's connect the dots. You had a temporary ceasefire, a sharp drop in oil, a rally in equities, and rising silver prices. That combination tells you one thing. The market was pricing in lower inflation and easier policy conditions. But now, that assumption is being challenged because with talks failing, uncertainty has returned. And we're already seeing early reactions. Gulf markets have started slipping as investors reassess risk after the failed negotiations, signaling that confidence is weakening again. Not panic, not collapse, but a shift, and shifts are where big moves begin. Now think about timing. This is happening over the weekend. Liquidity is thin, participation is low, and that's exactly when markets become unstable. Because when new information enters a low liquidity environment, price doesn't adjust smoothly, it jumps. And here's the part most people won't see coming. Because the system has already gone through 3 phases in just a few days: fear, relief, and now uncertainty again. That cycle creates pressure, and pressure creates volatility. So the real question is not, will silver move? The real question is, how fast can it reprice if expectations shift again? Because if energy risk increases again, inflation could rise. If inflation rises, Central banks may stay restrictive. And if real interest rates start moving again, silver doesn't drift, it accelerates. And if this breakdown is helping you understand what's actually going on, don't forget to like the video. It helps push this to more people before the next move happens. Now here's the key takeaway. This is not about predicting a guaranteed move. Markets don't work like that. But what has changed is the range of outcomes. The probability of larger, faster moves has increased. And when volatility expands, markets don't move step by step. They move in bursts, sometimes even gaps. And if that happens, most people won't be ready because they're still reacting to yesterday's headline, while the market is already pricing tomorrow's risk. Now let's go deeper, because this is where things start getting uncomfortable. Because what just happened with the ceasefire talks isn't just a headline, it's a trigger. The Islamabad talks, which lasted nearly 21 hours, ended without agreement, with both sides leaving major issues unresolved, especially around nuclear policy and the Strait of Hormuz. That's not a delay. That's a structural failure. And when diplomacy fails, markets don't wait for confirmation, they start adjusting immediately. Now here's the part most people are still missing. Even before the talks collapsed, the market was already unstable. Silver had surged over 4% during the week, holding above $75 per ounce, supported by a weaker dollar, and shifting expectations around interest rates. At the same time, that rally wasn't clean, because underneath it, volatility was building. Silver gained another 1.6%, even as investors questioned whether the ceasefire would hold, especially with ongoing disruptions and tanker risks near the Strait of Hormuz. Think about that. The market was rising while doubting the reason it was rising. That's not confidence. That's tension. Now imagine what happens when that tension finally breaks, because markets go through phases. First, fear, then relief, then confusion, and finally, repricing. Right now, we are entering that final phase. Pay attention here. This is where most people get caught off guard, because repricing doesn't happen gradually. It happens in layers. First layer, headlines. Second layer, institutional positioning. Third layer, liquidity shift. And then the move. Now let's talk about that move, because everyone is asking the same question right now. Is a gap actually possible? The answer is not simple, but here's what we do know. When markets reopen after major geopolitical shifts, especially over weekends, liquidity is thin, orders are imbalanced, and price discovery becomes aggressive. We've already seen how sensitive markets are. When the ceasefire was announced, oil dropped nearly 13% in one day, one of the sharpest declines in decades outside crisis periods. At the same time, the Dow surged over 1,300 points as markets rapidly repriced risk. That wasn't gradual, that was instant. Now flip that scenario, because this time the market priced instability and got uncertainty instead. That creates what traders call a gap risk environment, where price doesn't transition smoothly, it jumps. Now let's be very clear. This does not mean a guaranteed $10 move. Markets don't guarantee anything. But under these conditions, larger than normal moves become more probable. And here's why. Because silver sits at the intersection of three critical forces right now: geopolitics, monetary policy, and currency movement. If tensions increase, oil could stabilize or rise again. If oil rises, inflation expectations may increase. If inflation expectations increase, central banks may remain restrictive. And here's where it gets interesting. Because historically, silver doesn't just react to inflation. It reacts to real interest rates. If inflation rises faster than interest rates, real yields fall. And when real yields fall, silver tends to strengthen. But if central banks tighten aggressively, that can suppress silver temporarily. This is why the current setup is so complex, because both forces are active at the same time, which means volatility expands. And if you're still watching this, you're ahead of most people. Drop a comment saying gap if you understand what's building here. I want to see who's actually tracking this in real time. Now let's bring in the institutional angle, because while retail is reacting, smart money is positioning. Eric Sprott, one of the most well-known names in the precious metal space, recently invested around $7.73 million into Hycroft mining. That's not random. That's not short-term speculation. That's long-term positioning based on supply, demand, and cycle expectations. Now, this doesn't mean silver will instantly spike, But it does suggest something important. Institutional players are not ignoring this environment. They're preparing for it. And historically, these kinds of moves don't happen at the top. They happen during uncertainty. Now let's zoom out again, because this is bigger than silver. This is about the system. Because right now, global markets are dealing with slowing growth, sticky inflation, geopolitical instability, and that combination creates instability in expectations. And when expectations become unstable, price becomes unstable. That's where we are now. And this is why timing matters, because this is happening before the next open. This weekend, right now, markets haven't fully reacted yet, but they will. And when they do, they won't move slowly. If this breakdown is helping you see the market differently, hit like right now, because most people are still looking at outdated narratives. Now here's the real question. What happens when this move actually begins? Does it spike and reverse? Does it trend? Or does it trigger something bigger? Because there's one more layer we haven't discussed yet. And this is the one that could change everything. Now, this is where things stop looking like a normal market and start looking like a system under pressure. Because what we've discussed so far, ceasefire failure, oil volatility, inflation risk, that's only the surface layer. The real story is underneath. Right now, markets are not just reacting to headlines. They're reacting to uncertainty in the system itself. Because when the ceasefire talks collapsed after 21 hours in Islamabad, the issue wasn't just diplomacy failing. It was the fact that key structural conflicts remain unresolved, especially around the Strait of Hormuz, which still carries nearly 20% of global oil flow. And that matters more than people think, because when energy routes become unstable, everything else becomes unstable. Inflation, currencies, liquidity. Now let's connect this to silver, because silver is not just reacting to fear, it's reacting to stress in the financial system. Think about what just happened over the past few days. Markets went from extreme fear, sudden relief, ceasefire, and now renewed uncertainty, and this kind of rapid transition might create something very specific, a mismatch between paper markets and real demand. Now let me explain this simply. There are two versions of silver: physical silver, real metal, paper silver, futures, contracts, derivatives. Most trading happens in paper markets, but price is influenced by both. And here's where it gets interesting. Even during the ceasefire rally, silver didn't collapse. Instead, it held above key levels around 74, 75, supported by geopolitical uncertainty and a weaker dollar. That tells you something important. Demand wasn't just speculative, it was structural. Now combine that with something else, institutional positioning. Because while headlines were flipping between peace and conflict, smart money wasn't reacting emotionally, it was positioning quietly. Eric Sprott's $7.7 million investment into a silver mining company is one example of that. That's not a short-term bet. That's a signal that long-term value is being accumulated during uncertainty. Now ask yourself this: why would institutions accumulate when the market is still unstable? Because instability is where opportunity forms. And historically, some of the biggest moves in commodities don't start during stability. They start during confusion. Now let's go one level deeper, because this is where most people stop thinking. When geopolitical stress increases, what happens first? Oil becomes volatile. Then inflation expectations shift. Then central banks react. But there's a lag. And during that lag, markets become inefficient. That's where silver starts behaving differently. Because if inflation begins to rise again, but central banks hesitate to tighten aggressively, real interest rates fall. And when real rates fall, silver tends to move higher. But here's the catch. This doesn't happen smoothly. It happens in bursts. Now combine that with current conditions. You have failed ceasefire talks, ongoing tension in Hormuz military presence increasing in the region, markets already mispriced toward stability. That's not a calm environment. That's a pressure environment. And pressure doesn't release slowly. It releases suddenly. Now imagine this. Sunday night. Markets reopen. Liquidity is low, and traders are forced to adjust positions quickly, because now they're no longer pricing in peace. They are pricing in uncertainty again. And that shift can create sharp moves, not guaranteed, but possible. And this is where your audience needs to understand something clearly. This is not about predicting a crash. This is not about predicting a spike. This is about understanding when conditions become unstable enough for large moves to happen. And if you're still here, you're ahead of 90% of people watching this market. Comment system below. I want to know who actually understands what's happening beyond the headlines. Now let's zoom out one more time, because this is bigger than silver. This is about global positioning. Because right now, Gulf markets are already reacting, with stocks slipping after the talks failed, showing early signs of risk returning. Analysts are warning that oil prices could rise again if tensions persist, bringing inflation pressure back into the system. And central banks are stuck between controlling inflation and supporting growth. That's not stability. That's tension building across the entire system. And silver sits right in the middle of that. Now, here's the real question. If the system is under pressure and markets were positioned for stability, what happens when that mismatch corrects? Because that correction is where moves accelerate. And if this is making sense, hit like right now, because this is exactly what most people miss before big moves happen. Now, here's where it gets serious. Because there's one final layer we haven't discussed yet, and this is the one that could turn a normal move into something much bigger. Now, this is where everything starts to come together, because what we've built so far is not just a story, it's a setup. And setups in markets don't stay quiet for long. Right now, we have a very specific situation. The ceasefire talks between the United States and Iran have failed after 21 hours of negotiation, with major disagreements still unresolved, especially around nuclear commitments and control of the Strait of Hormuz. At the same time, analysts are warning that this failure could directly impact oil prices, inflation expectations, and global markets going into the next trading session. Now stop here, because this is the exact moment where markets transition from expectation to reaction. Just a few days ago, markets were pricing instability. Oil collapsed nearly 13% in a single move after the ceasefire announcement. Silver surged above 75. Stocks rallied aggressively. That was the relief phase. But now, that relief is being questioned. And when a market realizes it may have been wrong, it doesn't adjust slowly, it corrects. Now let's talk about the gap scenario, but properly, not hype. Not exaggeration, just reality. A gap in markets happens when new information enters. Liquidity is low and positioning is unbalanced. And right now, we have all three. This is happening over the weekend. Liquidity is thin and the information shift is significant. From temporary stability to uncertainty again. Now, here's the key detail most people miss. Experts are already suggesting that markets may open cautiously or slightly negative, depending on how oil reacts and whether tensions escalate further. Which means the expectation is not a calm continuation. It's a reactive open. And in reactive opens, price discovery becomes aggressive. Now let's bring silver into this, because silver is sitting at a very sensitive level, around $75 globally, and roughly Rs 2,060,000 per kilo in India as of April 12th, 2026. After a volatile week, where it held its gains despite uncertainty. That's important, because when an asset holds strength during uncertainty, it means positioning is already building. Now imagine this. Market opens. Oil starts reacting. Inflation expectations begin shifting again. And traders who positioned for stability are suddenly forced to adjust. That adjustment is where moves accelerate. But here's where we need to stay real, because this is important for your audience. A $10 move is not guaranteed. But under these conditions, larger than normal moves become possible, because silver right now is not trading like a normal commodity. It's trading like a macro asset. It's reacting to geopolitics, interest rates, currency movements, and industrial demand. And according to market analysis, silver has effectively become a pure macro trade during this conflict, meaning its movement is being driven more by global economic forces than by traditional supply-demand alone. That's a big shift, because macro-driven assets move faster. Now let's build the scenario step by step. First, oil reacts to failed talks because the Strait of Hormuz risk returns. Second, inflation expectations begin to rise again. Third, markets start questioning central bank flexibility. And fourth, real interest rates begin to shift. That combination is what drives metals, not instantly, not always cleanly, but powerfully. Now here's the key moment, because gaps don't happen because of one factor. They happen because of stacked pressure. And right now, Pressure is building from multiple directions. Failed negotiations, energy risk, inflation uncertainty, central bank constraints, and market mispricing. That's not normal. That's a compression phase, and compression leads to expansion. Pay attention here, because this is the exact moment where most people get trapped. They expect the market to move logically, step by step, but markets don't move logically. When positioning is wrong, they move violently. Now imagine the open again, not slowly, not smoothly, but aggressively. Price doesn't climb, it jumps. Reprices, searches for equilibrium, and during that process, you get spikes, drops, and sometimes gaps. Now again, let's stay grounded. This could also play out differently. Silver could open flat. It could consolidate. It could even pull back short term because markets are not predictable. But what has changed is the environment. The environment is no longer stable. It's reactive. And reactive environments create opportunity, but also risk. If you're still watching this, you're seeing the market before it moves. Comment open below. I want to know who understands how critical this moment is. Now here's the final piece of this puzzle. Because we've talked about geopolitics, inflation, liquidity, and positioning, but there's one more layer, and this is the one that can turn a short-term move into something much bigger. Now everything connects, because what we've been building toward is not just a move, it's a moment. April 12th, 2026. The ceasefire talks between the United States and Iran have officially ended without agreement after 21 hours of negotiations, leaving major issues unresolved and raising the possibility of further escalation in the region. And that one development may not just impact oil, it may not just impact silver, it may impact the entire system. Because this is where most people make a mistake. They think the move is the story, but the move is just the reaction. The real story is what comes after. Now think about what's already happened in just a few days. Markets went from panic to relief to uncertainty again. Oil collapsed nearly 13% after the ceasefire announcement. Stocks surged over 2,300 points. Silver rallied towards $75, $76 levels. And now that entire narrative is being questioned. That kind of rapid shift doesn't create stability. It creates fragility. Because when markets move too fast in one direction, they become vulnerable in the other. Now let's take this one step further, because this is the part almost nobody is talking about. If tensions continue and energy markets remain unstable, inflation may not come down as expected. And if inflation stays elevated, central banks like the Federal Reserve may be forced to stay restrictive longer than markets expect. That's the real risk. Not just inflation, not just war, but a mismatch between what markets expect and what reality delivers. And historically, that's where volatility explodes. Because markets don't break when things are bad. They break when expectations are wrong. Now apply that to silver. Silver is not just reacting to fear anymore. It's reacting to inflation expectations, interest rate uncertainty, currency movements, and global liquidity. And right now, all four are unstable. That's not a normal environment. That's a transition phase. And transition phases are where the biggest moves begin. But here's where we need to stay grounded. This does not mean silver will go straight up. It does not mean a guaranteed breakout. It does not mean a crash is coming. What it means is that the system is becoming more sensitive. And when systems become sensitive, small changes create large reactions. Now imagine the next few days, markets reopen, traders reassess positioning, institutions adjust exposure, and slowly the market begins to realize the stability it priced in may not exist anymore. That realization is where repricing begins. And repricing is where volatility accelerates. Now here's the final piece, because what happens next depends on one thing: confidence. If markets regain confidence, this becomes just another volatile phase. But if confidence weakens further, this could become something bigger. Not instantly, not dramatically, but gradually and then suddenly. And that's how most major moves begin. Pay attention to this moment, because this is not about reacting late. This is about understanding early. If you made it this far, you're already ahead of most people watching this market. Comment early below. I want to see who's actually thinking ahead instead of reacting. And if this breakdown helped you see what's really happening beneath the headlines, make sure you hit like and subscribe, because this is exactly the kind of shift that most people only understand after the move has already happened. Now, I want to leave you with one question. If the market was wrong about stability once, what else could it be wrong about right now? Because the next move won't come with a warning. It will come with a reaction, and by the time it's obvious, it may already be too late.